In today's video, I want to continue the discussion about the proposed 50-year mortgage. There's been a lot of discussion online, pros and cons, a lot of loan officers discussing it, a lot of people discussing it, and I think that's good. We need to discuss every single proposal that comes out of any administration. So the question of the day is, who should and should not take the 50-year mortgage? And I have evolving thoughts on this as more discussion comes out. And again, to remind you, it is just a proposal, conventional loans only. Now, overall, I do not like the proposal for many reasons. I have a few other videos that I've shot on this topic that explain the reasons why. That's the topic of this video. The topic of this video is who could get it potentially that would benefit from it, and who do I think it's not a good idea for? Because mortgage advice has nuance, which means that what's good for some people is not good for other people. So, and again, to remind you, this is not proposed for VA currently, but it very well could go to VA because of the way VA loans work. Typically, VA guidance often follows conventional guidance. And so even though it's technically not a VA proposal, I do think it is wise that we examine the ramifications of VA, because typically, like I said, if conventional guidance does in fact adopt this program, then most likely VA would follow. So again, mortgage advice has nuance. In other words, just because Dave Ramsey or somebody says you have to do it this way, I don't believe in that, or any financial advice, not just mortgage, but any financial advice. You have to understand your situation, understand the risks and the benefits, and figure out if those risks are worth it for you. And so let's talk about this. Who do I think absolutely positively should not take the 50-year mortgage? That's where we're going to start. And first one is people who live paycheck to paycheck. And that is because there is a risk that you could go underwater. And you're like, how would I go underwater? Well, because there are realtor costs and costs to sell a house. If the market does not go up quick enough and you sell the house in a short period of time, there very well could be a situation where you owe more on the house than you're going to make at closing. In other words, you have to bring money to closing to sell your house. Because typically a realtor charges about 6% commission, although that varies. They had the whole lawsuit and it does vary now, but typically it's about 6%. And then you've also got your other closing cost, title fees and filing fees, that kind of thing. So it's really about 7% of the cost of the house is going to go to selling it. And so if you put 3% down and say a week later you decide, well, I don't want this house, I'm going to sell it, even on conventional, well, you're already 4% underwater, right? And so you have to make that back. And so how do you make that back from paying off the loan? Well, if you're on a 50-year loan, that might take a while to pay it back. And so you're trying to rely on appreciation and make up the difference. And it's even worse on VA, by the way. VA, I have a whole other video where I ran the numbers. It's about 18 years to make that up, because you're doing a zero down loan. You also got a funding fee in there. It's actually about 18 years. And I ran the amortization schedule. That's a whole different topic. I have a second video on that, so I'm not going to talk about that a second time. But it's a lot. And so you're trying to rely just on appreciation. And what if appreciation doesn't happen? Appreciation is never guaranteed. Market could slow down, then we got problems. So definitely people live paycheck to paycheck. And next one is people with no savings, kind of similar situation. Again, what if you end up having to sell the house for and have money due at closing? That could be a problem. You don't want to be in a foreclosure situation in that case. The other one, kind of the same scenario, people who don't plan to stay in the home a long time. I do encourage you to get an amortization schedule or ask your loan officer for an amortization schedule to understand exactly how quickly the loan's being paid off. And because you need to know those break-even points. Now, like I said, mortgage advice has nuance. Who do I think should consider this? There are people that could benefit from it, and it's not who Trump says would benefit from it. And this is my frustration with the proposal right now, is they're using this as like this affordability play where, we're getting people to buy a little more home, a little more. And those are typically the people in the first category, people live paycheck to paycheck, people with no savings, things like that. And that's not actually who I think would benefit from this program. That's the irony of the whole dang thing, that the people they're selling this on are like the worst candidates to take this program. The ones that could potentially benefit aren't even being mentioned in this proposal. So, who do I think should consider this? First is a strategy, pay the least, invest the rest. And so this is for people that, have very good financial discipline, that are like, okay, I'm going to put 10% of my paycheck into the stock market. And I do think there is an argument to be made for the spread because, long term, the stock market pays, I think it's like 10%. So you're paying 6 on a mortgage. In theory, then you could make that 4% spread. And so for someone that's financially disciplined, maybe that's you, that's a viable strategy and something you should consider. Other one is real estate investors. I think it's perfectly fine for investors to take this product if it was ever available to them because they're putting 20% down. They are required to put 20% down. And so because of that, they had that cushion already that they would never be in a situation where they own more of the property's worth. And for investors, they're trying to make that cash flow. They're trying to make that rent and make the house pay for itself. And so going on the 50 could, in fact, turn a non-cash flowing property into a cash flowing property. Totally fine with that. And they're financially savvy enough. They know what they're doing. Perfectly fine candidate for the 50-year mortgage if it ever became available to them. Same thing, commission and bonus income. Oftentimes in these scenarios, because the way that works, you need that 2-year history. And so if hey, I'm on commission, what I'm qualified for based on the numbers is not really what I can afford. Like that kind of scenario where we're putting you on that 50-year to qualify you, but you're actually making extra payments. And have the discipline that, okay, I get that $25,000 commission that one day, that nice big bonus check. I'm either going to put it in the bank to save for a rainy day or just pay down principal on the loan with it. Hey, that's cool. I'm totally fine with that. I think that's a great way to improve your cash flow or even going like an interest only product. Heck, I've done that myself, because I work commission. I've always worked commission. And, I think those are fine for those kind of scenarios. And similarly, pay raise coming. You're working maybe some sort of internship type program and you're being qualified for lower income, but you're getting a pay raise, then okay, cool. Go on the 50. And then when that pay raise hits, start bumping that up, pay down that loan, or again, put it into savings just in case you're in a negative equity situation. Same with self-employment, similar to situation. Here's one that nobody is talking about, but I think there is a legitimate case to be made here for retired people. And here's why. When someone is retired, it's all about that cash flow. How do you make that Social Security check last? Now, ideally, you want to pay off the house, but what if you haven't paid off the house? What if you're sitting there and you're like, okay, I'm never going to pay this house off? Then I think there is a case to be made for taking out a 50-year mortgage and maxing out the qualification, maxing out loan to value, and creating a big nest egg out of that, and then using that 50 to basically make the cash flow work better. So now you have the lowest payment possible, but maximizing savings. And I think there's a legitimate reason to do that. And I think it's a good alternative to maybe like a reverse mortgage type product where you can't get nearly as much cash out of the home on a reverse as you could on the 50 or cash out. So I think in those scenarios where you understand the risks and you're like, okay, I'm gonna put some money in the bank and maybe you hadn't saved enough in retirement and you're trying to maximize that cash flow and maximize cash flow by having the lowest payment possible, then I think there is a legitimate reason to be made for the 50. So like I said, these are all very specialized scenarios. And these aren't even the ones that Trump and Pulte are talking about. But there's something to consider. Now, what do you think about the 50-year mortgage? I've talked about this in multiple videos. Comment below. I think this is something that we all need to discuss. I'm happy my loan officer peers are taking the lead on this. Because we are the ones that really have to tell you what the pros and the cons are of this program. Comment below with your thoughts. Also, if you have any questions about mortgage or anything else in particular, feel free to give me a call. My number is 937-572-3713 or scopeher.com. Talk to you soon. Bye.